$75.8 trillion. Take a second, just let that number sink in. It's absolutely staggering, right? Well, that is the looming developed market government debt load we are facing right now, looking ahead to the end of 2026. I mean, it's a number so massive, it's honestly kind of hard to wrap our heads around. But it is absolutely crucial to understanding the hidden mechanics of our financial system today. Welcome to This Explainer. Today, we're uncovering a fascinating and maybe a little bit scary dynamic that we like to call the iceberg economy. We're going to break down recent reports from federal regulators, Fitch ratings, and market analysts to understand a massive disconnect happening in our world right now. Because, as you'll see, the shiny, stable surface of our economy, it really doesn't match the massive macroeconomic threats lurking just below the waterline. Okay, let's dive into this with Section 1, the surface, a stable system. So let's start with the surprisingly good news. On the surface, things look incredibly solid. According to the Federal Reserve Board's Spring 2026 report, the proportion of large financial institutions, the really big guys, deemed well-managed is actually increasing. These massive banks are keeping their capital and liquidity levels well above what regulators require, and they're showing strong profitability. Essentially, the very top of our financial food chain, it looks like an absolute fortress right now. And this brilliantly illustrates that this stability isn't just limited to the Wall Street titans. Regional and community banks are also in highly satisfactory condition. In fact, regulatory warnings at these regional banks have dropped notably. They've returned to roughly the same calm levels we saw right before the banking stresses of 2023. The Federal Reserve Board basically sums up this surface-level view perfectly. They state that the U.S. banking system continues to maintain strong capital and liquidity levels alongside strong profitability and healthy loan growth. I mean, it's the exact kind of glowing report card you'd want to hang right on the fridge. When you read that, you naturally think, okay, the system is totally fine. It creates this incredibly comforting illusion of absolute stability. But that brings us to a really critical question. If the banks are perfectly secure, well-managed, and highly capitalized, where exactly is the danger? Why are we talking about an iceberg here? Well, to find out, we have to look past the bank branches on the corner and peer below the waterline of our global economy. Which brings us to Section 2, beneath the surface, exploding sovereign debt. All right, things get a bit more serious here as our narrative shifts underwater. Fitch Ratings recently sounded the alarm on this in their latest debt sustainability monitor, and the numbers are pretty sobering. Remember that $75.8 trillion figure from the very beginning? Well, that means developed market government debt equates to an astounding 104% of global GDP by the end of 2026. Let that sink in. Developed governments are essentially borrowing more than their entire economies produce in a single year. No way around it. That is massive. Now, what's really interesting here is looking objectively at the major deficit offenders driving this massive debt load in 2026. The United States is running the largest general government budget deficit at 7.8% of its GDP. France follows right behind at 5%, and the UK sits at 4.8%. These aren't small gaps. These are huge shortfalls that have to be financed through constant, relentless borrowing. So what exactly is driving these massive deficits? The sources outline several factual secular spending pressures. We're seeing severe strains on public finances driven by geopolitical shocks, like the U.S.-Iran conflict, which naturally drives up costs and dampens GDP growth. But it's also driven by long-term structural trends. Think aging populations that require more social care, unavoidable baseline increases in defense spending, and just the sheer crushing weight of higher interest costs on the debt these governments already hold. To give you a very specific sense of this spending squeeze, European defense spending alone is estimated to rise by an average of 0.6% of GDP between 2025 and 2029. When you pile that mandatory spending on top of changing demographics and higher interest rates, well, government budgets globally are just being stretched to the absolute breaking point. Moving on to Section 3, the specific time bombs, CRE and tech. So picture this. We have a fortress-like banking system, but it's floating on a turbulent ocean of sovereign debt. What could actually act as the spark to ignite this? Well, here is our first local catalyst, $875 billion. That is the exact amount of commercial real estate, or CRE, debt maturing in 2026 alone. Market analysts literally refer to this massive concentration of loans coming due as a maturity wall, and we are crashing into it right now. So the crucial point is this. The wall itself isn't actually the true threat. Loans mature all the time, right? The real danger is the repricing risk. These are commercial real estate loans that were mostly originated back in the 2010s during an era of rock-bottom interest rates. Now they're coming due, and they have to be refinanced into today's vastly higher interest rate environment. Property values might be lower, but the cost to borrow against them, that has absolutely skyrocketed. And it's not just real estate. The Office of the Comptroller of the Currency, the OCC, has laid out a whole list of salient, near-term wildcards that could act as the spark for this underlying economic kindling. They rapidly highlight things like cyber events, unpredictable geopolitical conflicts, persistent inflation keeping those interest rates high, rapid shifts in private credit markets, and, critically, AI-related issues. Actually, let's pause on that last point for a second, because it's a surprising and, frankly, somewhat terrifying note from financial regulators. They explicitly warn that artificial intelligence can actively increase the speed, scale, and sophistication of cyber attacks against the financial sector. So while AI offers massive operational efficiencies to banks on one hand, it's simultaneously augmenting the very threats that could destabilize them on the other. Let's move to Section 4 and see how this builds, preparing for the impacts. It's really easy to look at these big macroeconomic charts and feel disconnected from it all. But we need to bring this directly home to your wallet. The key takeaway here is that macro-level shocks eventually and inevitably trickle down to consumer wallets and local economies. You absolutely must care about sovereign debt levels and commercial real estate repricing, even if your local community bank seems perfectly stable today. Because when governments are squeezed for cash and real estate defaults rise, it tightens credit, it slows hiring, and it raises the baseline cost of capital for absolutely everyone. Which leaves us with this final provocative thought. With all these hidden iceberg-level pressures mounting just beneath the surface, from massive government debt to AI-powered threats to commercial real estate maturity walls, how prepared are you for a future where the baseline costs of living and doing business are fundamentally higher? Thank you so much for joining me for this explainer. I highly encourage you to dig into these numbers yourself and really consider how this iceberg economy might impact your own long-term strategies.